Learning outcomes. After studying this module, you shall be able to know foreign exchange markets, their structure and the financial instruments. Learn how foreign exchange market affects the economy and how it helps in international business and international transactions. Identify the various financial instruments, market segments and participants. Due to growth in international business, the foreign exchange market has shown unprecedented growth and development in the world economy over the last 30 years. Knowledge of international finance helps the financial manager to understand how international business can affect the firm and how to manage the events. The events that must be managed and changes in exchange rates, inflation rates and interest rates across the countries. The developments such as introduction of World Trade Organization, the expansion of international trade, growth in international investments have brought about a noticeable transformation in the size, structure, coverage and operations of the foreign exchange markets. The General Agreement on Tariff and Trade, that is GATT, and WTO has brought phenomenal change in international trade and cross-border investments. The dismantling of international trade barriers like reduction in tariffs and control has extended the scope of international trade to a variety of commodities and services. With the entry of various commodities in the international markets, the relevance of international trade has increased tremendously. Globalization of trade, which is based on the theory of comparative advantage propounded by David Ricardo, influences the foreign exchange market to a great extent. According to the theory, the different countries can benefit by exploiting the comparative advantage in efficiency that arise from specialized production and economies of scale. In fact, in some countries, foreign investments exceeded the domestic investments due to tremendous increase in the international investments. The growing number of multinational corporations also has contributed to the rise in foreign direct investments. The policies of liberalization and privatization have spurred a tremendous increase in cross-border investments. Developments such as mergers and acquisitions, cross-border alliances among financial service providers have brought revolutionary changes in the world financial markets. The expansion of international trade has caused financing needs to expand and encourage the development of new financial products. This has made international financial market grow larger and more integrated, sophisticated and efficient. Now let us discuss about the foreign exchange market. The foreign exchange market is also known as forex market or currency market or the FX market. The foreign exchange market is a global decentralized market for trading of the currencies of different nations. It is the largest market in the world in terms of the volume of trading. The foreign exchange market is not located in a physical space and does not have a central exchange. It is an electronically linked network market of large number of foreign exchange trading centers. Thus, the foreign exchange market provides a single integrated worldwide market by linking a large number of foreign exchange trading centers and markets all over the globe. Each country's currency is valued in terms of other currencies through the use of exchange rates so that currencies can be exchanged to facilitate the international business and transactions. The values of most of the currencies fluctuate over time because of market forces and countries' policies. We have here a list of selected countries with codes and symbols. In this table, you can see the country in the first column, the currency in the second column, then there is a currency code and then there is currency symbol. We can see the currency of the countries United States of America, United Kingdom, European Union, Japan, Switzerland, Australia, Canada and India. The global foreign exchange market is a 24-hour non-stop market. It has no fixed trading floor, no prescribed working hours and no single governing authority. Foreign exchange centers are spread throughout the world. The foreign exchange market works through large international banks and financial institutions. There are a large number of foreign exchange trading centers in the world and each country has its own center. The functioning of each trading center is governed by each country's laws, tax code, banking regulations, financial system and rules. Foreign exchange trading is not governed by any unified body, unlike the trading on stock exchange. Foreign exchange dealers or traders carry out their business through a network of communication provided by Society for Worldwide Interbank Financial Telecommunications or SWIFT. The clearinghouse interbank payment system, that is CHIPS, helps in linking various banks, dealers and traders involved in currency transactions. SWIFT was founded in 1973 by a group of European bankers for processing securities, trades and transferring international messages. This is a computer-based communication system. The banks and the brokers are in almost constant contact 24 hours a day. SWIFT provides the proprietary communication platform, products and services to allow the customers to connect and exchange financial information securely and reliably. SWIFT enables its customers to have direct access to confirmations of foreign exchange. SWIFT Net Mail provides a secure and reliable messaging service for transferring confidential business documents, contracts and signatures. CHIPS is located in New York and operated by Clearinghouse Payment Company LLC. CHIPS is an international wire transfer system for high value payments and is owned by the group of financial institutions. CHIPS is a clearing and settlement system which continuously matches and settles payment orders. The bank that purchased a foreign currency will have to pay the bank that has sold the foreign currency. The payment generally takes place via a clearing house or CHIPS. This is an institution at which banks keep funds which can be moved from one bank's account to another to settle interbank transactions. It processes more than 2 trillion US dollar fund transactions each day. Now let us discuss the history of foreign exchange market. The system used for exchanging foreign currencies has evolved over a period of time from the gold standard to a fixed exchange system and ultimately to a floating rate system. The first one is gold standard, which ranges from 1876 to 1930. Gold has been used as a medium of exchange because of its special qualities. According to the rules of the gold standard, the exchange between the two different currencies was determined by the relative convertibility rates per ounce of gold. Each country's currency was convertible into gold at a specified rate. Each country used gold to back its currency. In 1914, during World War I, the gold standard was suspended. During the Great Depression in 1920s, due to banking panic in the United States and Europe, most nations abandoned the gold standard as basis of their monetary system. Because of instability of foreign exchange market and the restrictions on international transactions during this period, the volume of international trade declined. Fixed exchange rate system. A fixed exchange rate is also called a pegged exchange rate, where the value of the currency is fixed against the value of the foreign currency. Fixed exchange rate system makes investments and trade between the two currencies easier and more predictable. Also, it facilitates domestic economic stabilization. The exchange rates are determined by monetary authorities without taking into consideration the demand for and supply of the currency. In 1944, an international agreement, the Bretton Woods Agreement, called for fixed exchange rates between currencies, allowing currencies to fluctuate within the range of 1%. This agreement lasted until 1971. In 1971, the US dollar appeared to be overvalued. The foreign demand for US dollar was less than the supply of dollars. Various nations' representatives met to discuss this issue, which led to the Smithsonian Agreement, and the US dollar was devalued relative to the three major currencies. Also, exchange rates were allowed to fluctuate by 2% in either direction. This was the first step to allow the market forces, that is demand and supply forces, to determine the appropriate price of a currency. Floating or flexible exchange rate system. The year 1973 marked the point where controlled foreign exchange ended and the more widely traded currencies were allowed to fluctuate in accordance with the market forces. The official boundaries were eliminated. A currency that uses a floating exchange rate is called a floating currency. Most of the currencies in the world are floating currencies. Examples of floating currencies are United States dollar, the Japanese yen, the British pound, Australian dollar and the European dollar. Floating exchange rates are preferable over fixed exchange rates as these rates automatically adjust. The Indian foreign exchange market. India, being a developing economy, has a long history of foreign exchange regulations, which was introduced in 1939 under the Defence of India Act to conserve foreign exchange and to ensure its use for imports. After independence, Foreign Exchange Regulation Act, that is FERA, imposed a complex set of controls on all external transactions. FERA conferred a wide range of powers to the Government of India to control and regulate foreign exchange inflows and outflows. The provision of FERA were rigorous and even a minor violation attracted severe penalties. Also, strict controls were imposed on current account transactions. The need was felt to remove the measures of FERA and to replace it with liberal foreign exchange management regulations. As a step in the liberalization process of the Indian economy, the exchange rate of the Indian rupee was allowed to float fully in the year 1993. In 2000, FERA was replaced by New Foreign Exchange Management Act, popularly known as FEMA, where the focus was shifted from conservation of foreign exchange to facilitate foreign trade. With the setting up of Clearing Corporation of India Limited, that is CCIL, in 2001, the foreign exchange market has become more liquid and vibrant. The focus of the new external sector policy of RBI has been to dismantle controls and provide an encouraging environment to all the participants. Authorized dealers were also being permitted to initiate trading positions and borrow and invest in overseas markets subject to certain conditions. The exchange market in India has three segments. The first segment consists of trade between Reserve Bank of India and the authorized dealers or the ADs. The authorized dealers are the commercial banks and other financial institutions. The second segment is the interbank market where the banks deal among themselves. The third segment is the retail segment in which authorized dealers deal with the corporate clients and business customers. The important foreign exchange market centers in India are Mumbai, New Delhi, Kolkata, Chennai, Bangalore and Kochi. Mumbai is the main center of foreign business in the country as a large volume of foreign exchange transactions take place through this center. Moreover, RBI, headquartered in Mumbai, is the regulator over the foreign exchange market in India. Now coming to the financial instruments. Financial instruments, also known as financial transactions, traded in the foreign exchange market are given below. Number 1, spot. A spot transaction is the most common type of foreign exchange transaction for immediate delivery of the currency, usually in 1 or 2 days. Spot exchange rates are determined by the demand for and supply of currency being exchanged in the interbank foreign exchange market. The interbank foreign exchange market is the largest financial market in earth. Forward. Forward transaction allows the purchase or sale of a specified amount of a foreign currency at an agreed upon exchange rate at a specified future date. The duration of the trade can be 1 day, few days or months. The date is decided by both the parties. Swap. The most common type of foreign exchange transaction is swap. In swap, two traders exchange currencies for certain periods of time and agree to reverse it at some later date. The next one is futures. Currency futures are standardized contracts that trade like conventional commodity futures on the floor of a future exchange. The basic function of the future transaction is to transfer risk from the hedger to someone who is willing to bear the risk for profit. The profit or loss on a future contract depends on daily movements of its price. Futures are derivative assets. Option. An option gives the buyer the opportunity but not obligation to buy or sell at a specified price within the specified period of time. The foreign exchange option market is the largest and most liquid market in the world. Like futures, options are also derivative assets. Now let us discuss about market participants, makers and segments. The first one is market participants. The main participants in this market are the larger international banks. Traders include large banks, central banks, institutional investors, currency speculators, corporations, governments, other financial institutions and retail investors. At the primary level, individuals who receive remittances denominated in foreign currency may sell their foreign currency for domestic currency, and those who travel abroad may buy foreign currency. At the next level, business corporations engaged in international trade may buy or sell foreign currency. Governments and other organizations require foreign currency for their international transactions. In the market, the facilitators who facilitate the conversion of currencies are primary dealers and brokers. Primary dealers act as a principal and conduct business in their own account by using their own funds, while brokers act as agents and do not commit their own funds. Brokers rely on brokerage commission or fees that they receive from clients, while dealers rely on their bid-ask spread. Primary dealers are mainly large commercial banks, investment banks and securities houses who are designated as authorized dealers in the foreign exchange market. Individuals and organizations that participate in the foreign exchange markets are classified as hedgers, arbitrageurs and the speculators. Hedgers are those who want to reduce foreign exchange risk by benefiting from favorable movements. Arbitrageurs make risk less profit by entering into two or more markets simultaneously. Speculators take positions in the market to make quick gains by anticipating exchange rate. They take position to profit from exchange rate fluctuations. Arbitrators and hedgers seek to examine risk by locking in the future exchange rates. But the speculator takes risk on the basis of their expectations about future exchange rates. Market makers. Many dealers in foreign exchange market act as market maker by offering two prices, that is the bid price and ask price, or buy and sell price for the currencies in which they are dealing, and seek to make a profit on the spread between the two prices known as bid-ask spread. Thus, market makers ensure liquidity and price stability in the foreign exchange market by providing continuous market and price related information. Large commercial banks, licensed dealers and money changers act as the foreign exchange market makers. The banks deal with each other at the wholesale level. Market segments. The foreign exchange market is divided into wholesale segment and the retail segment. Wholesale segment. The wholesale segment is also known as interbank market. The size of each transaction in the wholesale market is very large, and the exchange transactions take place between the banks, which are primary dealers and authorized dealers. It consists of central banks, commercial banks, investment banks, corporations and some wealthy individuals. The Reserve Bank of India intervenes in the foreign exchange market to correct violent fluctuations in the exchange rates due to demand and supply mismatch in the domestic foreign exchange market. The intervention of RBI is mandatory to maintain the stability in the market and also to influence the exchange rates in a desired direction. Retail segment. The retail segment consists of individuals, tourists, shops, hotels, restaurants and others. They exchange currencies in order to meet their specific requirements. Currency notes, travelers' checks and bank drafts are the most common instruments in this market. Foreign exchange needs of the retail segments are small and account for a small fraction of the turnover in the market. But the transaction cost is higher because of growing importance and small size of the retail segment. Let us summarize what we have learnt from this module. In the last 30 years, the foreign exchange market has shown unprecedented growth and development in the world economy. International finance has become more important because of increased globalization of financial markets. The General Agreement on Tariffs and Trade, that is GATT, and WTO has brought phenomenal change in international trade and cross-border investments. The growing number of multinational corporations also has contributed to the rise in foreign direct investments. Foreign exchange dealers or traders carry out their business through a network of communication provided by Society for Worldwide Interbank Financial Telecommunications or SWIFT. The Clearing House Interbank Payment System, that is CHIPS, helps in linking various banks, dealers and traders involved in currency transactions. India has a long history of foreign exchange regulations which was introduced in 1939 under the Defence of India Act to conserve foreign exchange and to ensure its use for imports. After the independence, the Foreign Exchange Regulation Act, that is FERA, imposed a complex set of controls on all external transactions. In 2000, FERA was replaced by a new Foreign Exchange Management Act, that is FEMA, where the focus was shifted from the conversion of foreign exchange to facilitate foreign trade. With the setting up of Clearing Corporation of India Limited in 2001, the foreign exchange market has become more liquid and vibrant. The focus of the new external sector policy of RBI has been to dismantle controls and provide an encouraging environment to all the participants. The foreign exchange financial instruments are spot, forward, swap, option and future transactions. The option and future are derivative assets. The main participants in this market are the larger international banks. Traders include large banks, central banks, institutional investors, currency speculators, corporations, governments, other financial institutions and retail investors. The foreign exchange market has two segments, the wholesale segment and the retail segment. The wholesale market is also known as interbank market. That's all with this module. Thank you.